Welcome back to Investing with Mackie. In this video, part 2 of using delta to estimate if options will be in the money. I took a further dive into the data and it looks like it makes a little bit more sense now. So we'll dive right into the data. I will post this code to supporters, but we'll take a look at what the data looks like. So first off, I added puts as well as calls. So as we scroll down, we'll see there's the code we were running. And first off, in terms of data points, on my charts, I have 99,000 call dots and 104,000 put dots. So ultimately, a lot of data here. It's just over 2 years from October 20th for SPY up until, I think it's like November 2nd or 3rd in terms of data there. So a good amount of data, of course, 2 years, and all those points are plotted. Now, as we take a look at those charts, the page slows down a little bit, but essentially we can see same thing as we saw before, this 1 O line basically dividing the close by the strike. So anything less than that means that the price closed less than the strike, so that means the strike was out of the money. And then the other way around, anything above means that it is in the money. So we can kind of see, right, the higher the delta, the more likely it should be in the money. Kind of looking at the 1.0, that appears to be the case. But when we looked at something pretty simple like the 0.5, it appears like the mass of the data doesn't quite match up. We should expect that to be pretty centered. So kind of led to some confusion when I looked at this data last time. Well, reading some comments, I decided to look at the put data. So scroll down a little bit further. Once again, this is nearly 100,000 dots here, or 100,000 data points for 2 years for SPY. And now we can kind of see we have 0.5 again, right? It looks like the mass is maybe above. We can kind of see a lot more dots basically above that 1.0 line. So same thing, except I divided the strike by the close instead of close by the strike, because in the money versus out of the money is different for puts versus calls. The other thing here is the delta is negative for puts, positive for calls. So I just multiplied it by -1, so that way the charts would look the same. So you can kind of see that there. I have these charts shared. If you look below in the description, you can actually download these charts as a web page and you can interact with them with yourself. Ultimately, we kind of see the broad strokes just by looking at the data that I have here. So as we continue to scroll down, I went ahead and just pulled the numbers. So it's hard to look at it visually and count the dots with hundreds of thousands of them. So what I did is, first looking at calls here, I looked at deltas by 0.1. So we can see from 0.1, 0.6, and we'll scroll down. I've got up to 0.9 below. And then I looked 0.02 on either side. So essentially, this is 0.08 to 0.12. And then I looked at it within different days to expiration. So we can see 1 to 7, 8 to 14, 15 to 30, 30 to 45, 45 to 70. So we can see here with the 0.1, we'd expect about 10% of those options to be in the money. Well, this first number is the number of data points that's in the money, and the second number is the ones that's out of the money. So we can see, if we look at the 0.1, 1 to 7 days to expiration, 16 in the money, and 713 out of the money. So that turns out to be 2.1%. So well below that 10% benchmark that we'd be looking for. And we can see that's pretty steady across all of the 0.1s. So right, there's 2%, 2%, 1.5, 1.4, 2.1. Well, let's look at that 2 delta, or 0.2 delta, right? Once again, 0.5%, 0.8. That's increasing a little bit, right? 10%, 12%, 8%. Okay. slightly higher, but still not matching the delta. If we go look at that 0.5, which is what originally led me to this question, we can see, right, we're in the 36, 38%. So well below 50%. Okay. Keep scrolling down and we can look at all these and we'll see, yeah, that's not really tracking. Okay, down to the 0.9s, that looks to be fairly close, right? 88%, 84%, 92%. Okay, so that looks good. Some of these 0.8 deltas, yeah, 75, that's pretty close. But let's take a look at the puts. So short-term puts, we can see like 22%, 14%, 13%, right? So well above that 10%. And then the 0.2s, right? Ooh, that's a 40%, 33, 33, 24. Look at some of these 0.3s, we got 53%. Okay, so if you're trading short-term puts and that 0.3 delta, right, that's nearly 50% whether you'll be in the money or not. All right, and this is all historical data, so that doesn't mean that's how it's going to trade moving forward, but it's interesting to see. So we kind of scroll down, and it looks like the puts tend to have a higher in the money percentage or likelihood compared to the calls. All right, so then I decided to combine all the data, right? Let's take those two data sets, combine them together, and see what we get. Well, our 0.1 delta, so we can see, look at that, 14%, 9%, 9%, 8%, and 5%. Well, that's pretty darn close to that 0.1 delta. We take a look at this 0.2 delta. We can see 23, 24, 19, 24. That's pretty close. The 0.3s, right, in the 30s. So that's pretty decent. 0.4 in the 40s, 0.5. Darn, that's pretty darn close, right? 50, 50, 50, 50. That exactly 50, right? So that's pretty awesome. And the 6s, the 7s, it tracks up pretty good. So it looks like when you look at options as a whole, it does actually turn out that historically it does match the predicted probabilities, which is why they're probably used, right? Why people can say that it's equivalent to a probability. Now, if you're trading one side of it, the calls or the puts, then it's going to be skewed one way or the other potentially. And this is just, again, with SPY. So if you take a look at other options that trend one way or the other, you might see something different. And then just as a point of reference to kind of close this out, we can see this is the first data point, right? So 2021, 20th of October, and then 2023, the 3rd of November. Now, one thing we'll note is the price pretty close, right? But ultimately ended up $4 down between that 2-year period. So it makes sense that more puts would be in the money as opposed to calls. And then just to kind of see some dots here, here's where it was at the beginning. A lot of volatility, it looks like, right, over the last 2 years, coming down, nearly $100 down from the high and coming back down here. And then over this last week, we saw, a pretty decent spike back up with all the Fed data coming in and then the job data coming in as well. So ultimately, it looks like the delta can potentially be used, right, as long as it's used holistic. You can't just look at just the puts or the calls. You got to kind of take everything in consideration. So I think that kind of closes out this topic. Still, clear as mud, but definitely an intriguing thought to know that maybe that delta can be used, right, from a holistic point of view. With that, let me show you quick. I've got a link below for these charts. So if you want to pull up the colorful charts, you can come here. You can download these two files, see their HTMLs. So once you download them, you can open up, and then you basically have this view here. Now, how these charts work is you can, when you have this zoom, you can kind of click and zoom into an area you want. So if you want to look at like a certain delta or certain ratios. And then if you want to look at specific days to expiration on the right side here, you can double click on a value. If you double click on a value, well, it'll only select that one. And if you single click, it'll select and deselect. Say I want to bring in, let's just look at the 15, double click that. And we can get just the 15. So you got to mess around with it. They'll zoom out, auto scale, take us back to here. So mess around with it if you want. Ultimately, I think we kind of have a final solution on this, but yeah, feel free to play with the charts. If you like these videos and you want access to the data, I recommend you check out my Patreon, link below as well. And then go ahead and subscribe to see future videos. I think the next thing we take a look at is put call ratios for SPY, take consideration in the money versus out of the money, and what correlation that has with future prices, whether that be 14 days out, 30 days out, and then maybe the change in those put to call ratios. So a couple different things to look at there. Obviously, those are things that are used, but how accurate over the last 2 years is that data? Is there a correlation? Is it leading? Is it trailing? Or does it basically just follow whatever the price is actually doing? So with that, thanks for checking out this video, and I look forward to joining you on our next one.